Minneapolis Fed President Neil Kashkari added to the list of Fed heads, saying a rate hike in June is still too close to call. Joining us now with his take, Roger Ferguson is a former vice chairman of the Federal Reserve and a CNBC contributor. Roger, great to have you with us. Do you think it's too close to call at this point? What data are you looking at?
So I do think it's too close to call. As I listened to what Neil Kashkari had to say, he focused in where I think everyone is, which is the inflation number themselves, with the recognition that inflation is still very, very sticky, and with a specific focus in the service sector, which is the area where, frankly, the job market tightness is going to play through most directly. So those are the numbers that one would look at, and I think it's really a toss-up at this stage, which may be a little bit of a surprise given how much they've already moved.
Are you in the camp of Neil Kashkari, who said that there should be a pause, but a signal that there could be more tightening ahead? Or let's say a Bullard who says front loading is better. So there's a front loading and a wait and see kind of, just separation in the Fed. Where would you stand on this?
I think I'd stand closer to the wait and see. They've moved quite a bit at a historically fast pace. There's a great deal of uncertainty in the economy from the banking sector. That hasn't shown through everywhere. And you heard from Neil Kashkari yesterday that in his district, he didn't see much impact from banking uncertainty. We are hearing from major companies expectations of a slowing. And so I think from my standpoint, perhaps if they feel necessary to do one more, then I would definitely take a pause and just take a survey to see exactly where things stand.
In terms of the banking impact, Roger, I mean, we've already seen some evidence that there is a tightening of credit. And so what further impact would you see? Is it beyond the credit, credit tightening? Is it commercial real estate? I mean, what are some of the other impacts that you are expecting that will eventually factor into the Fed's decision?
Well, I think it's mainly that tightening of credit. And the question is, how widespread does that become? We know it is an issue for some banks and some locations. It doesn't really appear to be a national phenomenon yet. And that is, I think, really where one would look. The other point to recognize, when interest rates rise, there's an expectation that credit would tighten somewhat. So it's not a total surprise. The question is exactly how extensive that has been and likely to be. Thus far, I think it's a watch out. Has not yet become a major factor in monetary policy thinking, as far as I can tell.
If you were to speak to a market participant who believed that there were rate cuts sometime at the end of the year or early next year, what would you tell them? Are they off the reservation? Or are they, in line?
Well, I think the market is misreading the Fed's intention. I think the market is not focused enough on how sticky this inflation appears to be. The other thing is I think the market is thinking a little slowdown, maybe a modest recession, would force the Fed to change its thinking. I believe the Fed actually expects that there may well be a modest recession, and that is, I think, part of what's in their plans. No one wants a recession, but I'm not sure that if that were to occur, the Fed would feel obliged to immediately pivot and start cutting rates right away, because it's part of the process of driving disinflationary forces deeper into the economy.
It's interesting, how people are trying to characterize the degree of the recession that is expected, whether it be short and shallow or moderate. I mean, in your view, what is moderate recession, Roger? I mean, is that unemployment peaking at 5.8% next year, which is the way J.P. Morgan is modeling for its credit reserves, or is it something deeper or less bad?
I certainly think it's less bad than the recession that we had, two recessions ago in 2008. I think it is unemployment peaking somewhere in the mid-fives, perhaps. Most importantly, I think it's 2 quarters, the sort of technical definition of perhaps slightly negative growth. But it's the kind of thing that I think the economy would snap out of pretty quickly. And will be due almost exclusively to Fed policy tightening, maybe going just one too many, given the uncertainty that exists around the banking sector and other things that we've talked about.
Why do you think the economy would snap out of a recession pretty quickly? I mean, what about it? I mean, if we do see unemployment go higher, is it just that the unemployment rate won't be as high as past recessions, and so therefore there is still a strong employed base out there, that we've seen pretty good gains in wage growth? What makes us a little bit more resilient if we are to weather a recession?
I think you put your finger on it. First, there's a fair amount of forward momentum in the economy that I think surprises many people. We see steady demand across the board, so to speak. Secondly, the labor market imbalance is still really historically, quite great, with 1.5, 1.6 job openings. Normally, the number is 1. And I think the Fed is rather hoping that we can have this sort of modest increase in unemployment, still have plenty of demand for jobs, and still have consumers that are relatively strong. And I think that forward momentum, if it occurs, is the backdrop for a recession that is relatively quick, relatively shallow. And let's hope, if we have one at all, that that's the type of recession that it looks like.